Okay, good morning and welcome everyone to our economic webinar forecast for North and Latin America. I'm Carolina Almeida, Marketing and Communication Director for COFAS Latin America, and it's a pleasure to be here today. Today our speakers will be Ruben Nizar, Economist for North America region and Head of Political Risk Analysis, Patricia Kraus, Economist for Latin America region, and Mariano Lastreto, our Commercial Director for Latin America. All presentations will be made in English, but if you prefer to listen it in Spanish or Portuguese, you can enable the simultaneous translation by clicking on the globe icon at the left bottom of the screen and selecting your desired language. As usual, at the end of the presentations, we will have a Q&A session, and you can submit your questions at any time during the event using the chat box. I would like to thank you for being here today, and to kick off our session, I will now hand over to Mariano. Welcome, Mariano. The floor is yours.
Thank you, Carol. Well, welcome. Hello, everybody. Welcome, and thank you for being here today with us. It's a great pleasure. It's a great pleasure always for us to organize this kind of events that allow us to share a little bit of our experience, our knowledge. This time, the webinar with the focus on the opportunities and challenges in Latin America and in North America. We have more than 1,000 people connected from 15 different countries, so a great audience. So I could assume that most of you already know about COFAS, what do we do? But I would say that the assumptions are not really good in terms of communication. So to begin with, we would like to share a little bit of our history, who we are, what do we do, and to share with you what are the solutions that we provide to our clients. So first of all, a little bit of our history. COFAS was born in 1946 in France after the end of the Second World War. At that time, as you can imagine, the situation in France was really critical, as the same for the rest of the countries in Europe. So COFAS was created by the French government mainly to support companies to do business, to trade. At that point, doing that within France was really difficult. So the main option was through export outside of Europe. That is why at the beginning we were specialized in credit insurance for export only. Over the time, we expanded our presence internationally. We became private, and now today in 2023, we are a publicly listed company, and we are one of the leaders in the sector. We have more than 75 years of experience. We keep supporting companies. That's our core business. We support business-to-business trade. It doesn't matter the size of the company, for all sectors, and for sure that we keep supporting French companies, but not only. We have more than 50,000 clients in 100 countries. We are able to provide them with coverage and solutions in 200 countries. In Latin America, we have been present for more than 35 years. We have local presence and teams in Argentina, Brazil, Chile, Peru, Colombia, Ecuador, Mexico. And we are also able to issue policies and provide solutions in Guatemala, Panama, Paraguay, and Uruguay, thanks to our partners. So which kind of solution do we provide to our clients? Our main areas of expertise: credit insurance, our core business. We also provide with business information for our insured companies, but also for non-insured. I will talk about these two topics a little bit deeper in the next slides. We also provide debt collection solutions for insured and non-insured companies. We also work with single risk in some complex operations, bonding and factoring mainly in Europe. So going a little bit deeper, what is credit insurance? Credit insurance, if we search for the definition on the web or in a dictionary, if you are more like an old school person, you will find a similar definition like this. Credit insurance, it's an effective tool for risk management, which enable a company to protect its trade receivables against the risk of customer non-payment. So first of all, it's a very effective tool. To do what? To manage the risk. Which kind of risk? The risk of non-payment. And how do we do that? By protecting the trade receivable. So it's quite powerful, but I'm glad to say that it's much more than that. And a good way to see that is to see the three effects or the three steps where the credit insurance impact in companies. First of all, it allows you to transfer the risk and to work in the prevention. How we do that? Thanks our assessment and monitoring on your portfolio. We have a database including more than 130 million companies. This is one of our main assets. We have 53 information centers around the world that they are collecting and updating this database on a daily basis. And this information is used by our more than 800 analysts to make decisions and to control and to alert our clients to avoid and prevent losses. Of course, nobody can read the future. Nobody has the crystal ball. So the credit insurance, it will also allow you to mitigate the risk in case of a non-payment. We will put in place all our recovery actions. We have more than 330 people around the world. We also work with international networks that allow us to reach every corner of the country, reaching more than 200 countries. And of course, that give us also all the legal knowledge that we need to be aware in each case. At the end, if we are not able to mitigate or to collect the full bad debts, credit insurance also works as a safety net. We will be indemnifying, depending if it's an insolvency, it will be just after the insolvency, no real need, no really needed for collection. In case of a protected default, we usually wait for the waiting period, which is around 150 days that we will be also working on the collection. We are able to do this all over the world thanks to our global expertise and what we call boots on the ground, the local presence that we have in 100 countries. But how does it work in practice? So just to give you a little bit of the flavor of credit insurance, it's a very simple example. First of all, to explain that at COFAS, we have close to the risk, close to our customers' organization. That means that for us, we believe that the best way to assess the risk is to be as closer as we can to the risk. And of course, to give the best service to our clients is to be as closer as we can to the client. In this very simple example, we have a client insured in Spain. Let's say that this client is selling and producing handmade shoes. Let's say that this client goes to the fashion week in Paris. They meet a prospect. The prospect is located in the Netherlands. This prospect really liked the shoes of our client and asked them to sell 1 million merchandise of shoes by credit. So our client today is only selling within Spain on domestic sales. So this is a very good opportunity for them to expand the business and to enter into a new market. So what do? They request a credit limit on our app, for example, on CofaMove on the phone. Our risk underwriters in the Netherlands will receive the request, will analyze the situation of the buyer, and in one day, which is usually our average response time, they will answer for the credit limit. As I am a very optimistic person, they say they approve the limit, and then once we approve the limit, we will keep working on the monitoring of the risk. If there is any inconvenience at some point, we will put in force our collection team where in the Netherlands where the risk is, and if we are able to collect, our client in Spain will be receiving the fully recollection from our actions. At the end, after the waiting period, if we are not able to collect the debt fully, we will indemnify the remaining amount. Let's say we recover from the 1,900,000. At the end, we will be indemnifying usually around 90% of the remaining debt, meaning 90,000 of the debt. This is a very simple example. It works for domestic sales, but also for exports. So to summarize a little bit, the benefits of the credit insurance, they will help you to secure your margins. You will be limiting the impact in case you suffer an payment. You will have a better view on your client's portfolio, knowing which of them are quite stronger and which of them are weaker. It will help you also to better manage your internal processes in terms of governance, to put more strict and organized processes. It will help you also to access to financing, for example, by factoring the insured invoices or through capital relief or other options. Credit insurance, it will also optimize your balance sheet as you will be securing one of your main assets, the account receivable. All in all, you will have the warranty that when you sell or you will receive the money at your bank account from the client or from the company, and this will give you the tranquility and the peace of mind that the continuity of your business we will never put in risk. Just to share also a little bit of our information services. Today, we provide with information to more than 12,000 clients that they are using our information to make decisions. Just to explain you, this information that we produce, it's also the same information that our analysts are using to make more than 10,000 decisions per day. And this is also how we monitor and we secure our exposure of 670 billion of exposure that we have in our books. We have different types of information that can suit your needs, depending if what you're doing is try to, I don't know, create a new partnership with a company to define a new business strategy, or you would like to secure your suppliers, or because of your procurement procedures, or because of the requirements of your local law. You can also anticipate and protect yourself, having the updated information in some markets. Some of our clients use credit insurance in some markets and use information for others. That's also an option. And this also gives you the chance to monitor the risk evolution on your clients and be prepared. We have different products. We have, I would say, more detailed business reports, more lighter ones, bio-risk assessment and credit opinions. We can also provide you with company monitoring, automated reports, credit scores, or if what you are looking for is more detailed and robust information, we can also provide you with business information reports, including financial information that is unique from COFAS based on our payment experience. So all in all, depends what we are looking for, the solution that we can give you. All this information will be available for you through our digital platform, very easy to use. In a few clicks, you will have all the information that you need. So we encourage you to test us and to ask for a sample to have a better view on what we are showing here. Just to finish and move to the main topic of today's call, I don't want to spoil the presentation from Bruno and Patricia, but we all are aware that we are living in a very complex environment, very dynamic and very volatile. We know it's difficult to do business. There are things that we can control and other things that we cannot control. So here the invitation is to propose you that you don't need to be alone during this journey. We will be delighted to go with you and to build a partnership together, and with us you will be benefiting from a solid partner, a strong partner. You will have access to our international network. You will have access to our team. We will be able to understand your needs and to put on the table a solution that makes sense for you. You will have access also to our extended database. You will have access to our risk underwriting, to our economists, to our debt collection team, and of course, all the tools that we have available to manage this kind of insurance. So the invitation is to say this is just a very rapidly introduction. If you're interested, at the end, you would like to know more about our products, we will be more than happy to have a conversation with you, to understand your needs, and to be able to put some useful solutions for you. So if you have any questions at the end of the session, we will be answering them. Now, let's move. Bruno, I will give you the floor to go to the most interesting part of the session. Thank you.
To Ruben.
Ruben, sorry.
Ruben. Ruben,
Sorry.
the floor is yours. Thank you for joining us.
Thank you, Mariano. Thank you, Carolina. Good morning. My name is Ruben Nizar. I'm COFAS economist for North America, based in Canada. So today I'll be discussing our economic outlook, and more precisely, I'll give you a brief overview of our global economic outlook before going more specifically into details on the US economy and the trends and outlook for the US economy, which of course has a big impact on the global economy and particularly on the trends in the Americas. So before I start, I just wanted to show you our country risk assessment map that was just updated last month. This map gives you assessments on an 8-step scale from A1, a very low risk of business default, to E, an extreme risk of business default, and give you a comprehensive view of our opinion on a country based on our macroeconomic and financial analysis, based on political risk analysis, as well as our assessment of the business environment. And we use also our payment experience to inform these assessments. All this information, as well as our views and several publications on our global economic outlook and more topical studies, including payment surveys, are available on our website. But let's start with the global overview, and maybe you'll be able to understand a bit better what are behind these assessments. And the global picture is that after a strong recovery from the COVID-19 pandemic, the global economy is now slowing. You can see that reflected in the left-hand side chart that shows our real GDP growth forecast at the global level. And after about 3.1% in 2022, you can see that we forecast 2.2% GDP growth this year and 2.3% GDP growth in 2024. But what does it mean? It might be a bit difficult for you to understand what 2% GDP growth at the global level means. So you can already see from this chart that it's quite slow when you compare it to the decade before the COVID-19 pandemic, where global GDP growth averaged about 3%. So already you can see that these 2% is pretty much an outturn that is disappointing for the global economy. Second thing that I like to mention is that 2% GDP growth is actually quite rare at the global level. If you look at the past 25 years, it only happened 4 times, and that was in 2001, global economic slowdown and recession in the very mild recession in the United States. That was 2008, 2009, great financial crisis and global recession, and 2020, the recession triggered by the COVID-19 pandemic. So 2.2, 2.3% is just above this 2% threshold that indicates very slow economic growth and a major slowdown. A slowdown that, as you can see, again, with this chart on the left-hand side, is mainly driven by slowing economic growth in advanced economies. So I'll detail it a bit further with the US, but we can already see that in advanced economy, the impact of rising inflation, which has surged to multi-decade high in most advanced economies, as well as tighter monetary policy that is creating some tighter liquidity and credit conditions, are impacting business and consumer spending and hence slowing economic activity. We can also see the impact of the war in Ukraine, and as a result of the energy price shock in Europe, Europe experienced a mild technical recession in the winter of 2022-2023 that is weighing on our GDP growth forecast for 2023. So for North America and the US, there's a bit more resilience, as I'll explain. And while economic growth is slowing, we don't forecast a recession for now. And we have seen some signs of this resilience being confirmed, but the momentum is definitely slowing, and we are likely to experience subpar economic growth going forward. When it comes to emerging markets, they're a bit more resilient, and we can see that most of the growth will come from these emerging economies. The rebound in China, the recovery in China, as it reopens from harsh COVID-19 restrictions in 2022, is providing a boost to the global economy and to Asia Pacific in particular. But at the same time, it has to be said that while China is recovering and rebounding from a low economic growth in 2022, the expected economic activity in 2023 and 2024 remains below the standards of Chinese growth over the past few decades. And we are seeing some signs that consumer spending in particular, after a boost from the reopening, is now slowing in China. And this is hence less of a driver of economic growth and will be less of a driver of economic growth as it has been over the previous decade. We are also seeing some resilience in some commodity exporting countries, particularly energy exporting countries in the Middle East and Africa. For Latin America, Patricia will give you a clear picture of what is happening, but you can already see here that Brazil and Mexico, we are forecasting a slowdown. So that's for the global picture, which is already proving to be a challenge. So now let's look more precisely at what is happening in the United States. And when we look at recent trends in the United States, and when we look at the global economic, at the general economic environment in the United States, what is particularly striking is the resilience of economic activity to the headwinds that we've seen emerge in recent months and in the past 2 years. So these headwinds, I've already mentioned them, are rising inflation and tighter monetary policy that are expected to actually slow down consumer and business spending and to push the economy into a difficult situation. But when you look at this left-hand side chart, which put together all the monthly indicators that the National Bureau of Economic Research in the United States follows and track to try to identify if the U.S. economy is in recession or not, you can see that global economic activity and U.S. economic activity has continued to advance. It has slowed to some extent, but this resilience is quite remarkable. In particular, we see some resilience in the job market, in the labor market, with an unemployment rate that is still near a 50-year low, around 3.5%, 3.6% more precisely in June of 2023, which is supporting income despite the rise of inflation. And you can see that real personal income, excluding transfers, has stabilized despite the eroding and power of inflation. And this has in turn supported consumption. Also to mention, when it comes to the resilience of the U.S. economy, there are several factors playing into that. The resilience of the labor market and the continued growth of income is one factor, but the cushion of excess saving that was built during the pandemic is another factor that was very important in supporting consumption, which accounts for about 2/3 of U.S. GDP. So of course, when consumer spending holds up, it supports the economic activity momentum in the U.S. And you can see on the right-hand side chart that after accumulating some excess savings compared to pre-pandemic trends in 2020 and early 2021, you can see that households have dipped and have drawn down into these excess savings to actually continue to spend and to continue to finance the spending and cushion the impact of higher inflation and higher borrowing costs. So 2/3 of these cushion of excess savings has been now drawn down. So that's a concern for the outlook. But at the same time, we are continue to see resilience in the labor market. And as long as the labor market continue to be strong, I do believe that the U.S. economy will be able to avoid a recession as spending will likely continue. When it comes to the resilience of the U.S. economy, it's also very interesting to look at the state of the housing market. Why? Because the housing market is considered to be a very cyclical sector and respond quite rapidly, notably to the rise in interest rate costs. And you can see from the left-hand side chart quite nobly that in 2022, real estate activity, housing sales has declined quite meaningfully, declining by about 40%, give or take. as a result of higher interest rates impacting mortgage rates and hence sales activity. But what is very interesting in these cycles is that construction activity has held up pretty well. And that's what you can see on the left-hand side, on the right-hand side chart. While housing starts have indeed slowed down, we have seen construction and construction activity continue to be supported by a pipeline of projects that was delayed by supply chain issues and supply chain bottlenecks. And now we are seeing even a rebound as in the housing sector and a recent rebound in housing starts that is suggesting that the worst for the housing market could be behind us. And this is a result of the stabilization of some of the economic condition. So in my opinion, what is happening currently in the residential construction and residential real estate market in the United States is very interesting in understanding this resilience and understanding why this resilience could last a little bit longer. But while the resilience is remarkable, it is also important to note that the risk environment remains very high and that risks are still ahead of us. And when we talk about risk in the United States, of course, the first question and the first issue that comes to mind is inflation, which has risen to a 40-year high of 9.1% in June of 2021. Well, there are some good news when it comes to inflation in the United States, and the inflation report that was released yesterday by the Bureau of Labor Statistics gave some more positive news in the front of inflation, showing that inflation was slowing. For 12 consecutive months, inflation has slowed, and you can see that the headline annual inflation rate has been divided by 3 from its 40-year high reached last year to just 3%. So good news. But while this is good news, this is not the end of the fight against inflation for central banks. First of all, 3% is not 2%, which is the target of the Federal Reserve. So this suggests that there's still some work to do to get from 3 to 2%. And actually, getting from 3 to 2% might be the most difficult part of the job for the Federal Reserve, as we are seeing some signs of stickier price pressures and inflationary pressures, particularly in the core components and underlying components of inflation in the United States, that could leave inflation higher than what the Federal Reserve is targeting. You can see on the right-hand side chart the different contributions from different spending categories to inflation. And you can see that the decline in energy prices and goods prices has been the main driver of this decline in headline inflation rates. This is a result of the impact of supply chain bottlenecks easing and easing also price pressure on energy as the initial impact of the war in Ukraine faded, coming into play. But as this base effect would likely start to fade in the second half of the year, it will likely leave inflation rates higher than the 2%, and the decline in inflation might stall a little bit going forward, leaving the Federal Reserve on tightening mode and on a restrictive stance. More particularly, we are looking at prices in services, and while there are some encouraging signs in the latest reports, this is not consistent right now with the 2% inflation target of the Federal Reserve. And that's why, after being very aggressive over the past 16 months to try to combat inflation, raising interest rates by 5 percentage points in just these since March of 2022, we are likely to see the Federal Reserve slow in the first place with interest rate hikes. They've already maintained their interest rate steady at their latest meeting. And while they are likely to do one more hike at the end of the month at their July meeting, this will likely mark the end or close to the end of the rate hiking cycle. But while this is the end of peak hawkishness for the Federal Reserve, it is important to note that it has indicated, and considering the resilience of economic activity indicators and considering signs of sticky inflation, that the Federal Reserve will maintain a restrictive stance on economic activity going forward. And this will impact the economy. And we know that monetary policy works with long and variable lags. This is the expression and phrase that you can often hear and read in the news, but this is true. And we've only been 15 to 16 months into this hiking cycle, so we haven't yet seen most of the impact of the Federal Reserve hiking cycle, and it is likely to come. And we have already started to see some of this impact on the housing market, as I've already mentioned, but we've already seen it also on the local banking sector, as the rise in interest rate hikes has put pressure on smaller lenders, which had some issues on the balance sheets, such as Silicon Valley Bank, Signature Bank, and First Republic, which failed this year. So this was, in our opinion, a signal of this lag in monetary policies. The good news that we have on the US banking sectors is that it appears that the crisis is contained. We can see that after declining following the collapse of Silicon Valley Bank in March of 2023, you can see that bank equities and the stock prices of most banks in the US, also in Europe and in most countries, have stabilized a bit lower than what they were in March, but they have stabilized. You can also see from this right-hand side chart, and this echo what is likely the truth, is that most of the concern are concentrated on smaller regional lenders in the US banking sectors going forward. So that's, while it is, the situation has stabilized, it is important to note that there remains some pocket of risks in the regional banking sector in the United States. And we can see that from deposit flows. We have seen right after SVB large outflows from smaller lenders. That's what you can see on the left-hand side charts. So if there are some other signs of turmoil that start to emerge in coming months, that could create renewed pressures on some of these banks and create some more difficulties. But the good news that you can also see from this left-hand side chart is that deposit outflows that had started before SVB collapse as a result of the Fed monetary tightening cycle has stabilized somewhat. I think it's also interesting when we try to assess the current state of the US banking sector to look at Federal Reserve emergency lending that they've put in place to support the local and domestic banking sector. And you can see that after Silicon Valley Bank collapse, we've seen an increase and a sharp increase in these emergency lending programs. The good news is that it has stabilized somewhat also, and this also suggests stabilization of the state of the U.S. banking sector. But you can see that that request for the Bank Term Funding Program has continued to inch up over the past 2 months, which suggests that some smaller lenders still have some stress on their liquidity and might be subject to some stress. So this is something that we continue to follow, and although things seem contained for now, risks remain. And another thing that is likely to happen with smaller lenders and small institutions being vulnerable is consolidation in the U.S. banking sectors, with large lenders likely absorbing smaller lenders. But when we talk about the banking sector, another thing that we were concerned about was the impact that it will have on credit conditions. With more stress and deterioration in the perceived outlook, we were worried that it will trigger a credit crunch that would push the U.S. economy into a recession. The good news is that we didn't see in the data, any of the data that we have so far, we don't really see a sudden stop in lending. But what we are seeing is that we are starting to see the lags in monetary policy starting to work out. And the tightening in credit conditions that is reflected on the left-hand side chart with this chart on the survey of lending condition is a reflection of these tighter credit conditions starting to impact the U.S. economy. And in terms of lending flows, we're also starting to see slower lending flows, and this is reflected on the right-hand side chart. So here we have weekly lending flows, so it is contracted. When we actually look at year-on-year growth, it's still positive, but it is slowing fast, And this conditions of slower credit creation is likely to create, and the squeeze on credit is likely to create a negative credit impulse, which will weigh on economic activity going forward. And that's what we are likely to see, and that what we are already starting to see, and particularly lending to commercial and industrial loans are slowing quite meaningfully, and this is likely to translate into slower business spending and business investment, which will impact the outlook. Second thing that I want to mention is that with this squeeze on credit condition, it is likely to create more insolvencies, an indicator that is very important for us at COFAS because insolvencies are often the trigger for a non-payment. And what we are seeing already in the US is that after a period of very low bankruptcy activity and low insolvency activity in 2021 and 2022, as the recovery was strong, as government support was strong, we are seeing a pickup and quite a meaningful pickup in bankruptcy activity. And this is of concern. If we just take a look at the first quarter of 2023, year on year, bankruptcies, US bankruptcies rose by more than 33%. And indications for the second quarter is that this increase in bankruptcies has likely accelerated. So what this suggests is that levels of bankruptcies are likely to normalize and to return to normal before the end of 2023 and could go beyond the average 22,000 bankruptcy levels that the US economy was recording in 2018, 2019, when economic conditions were considered to be, and when the seed cycle was pretty mature. So this is something we keep a very close eye on going forward for the US economy, as while there is some resilience on the micro side, we are seeing some signs of cracks starting to appear. To conclude, I'd just like also to share our sector risk assessment for North America, and much of the assessment changes that we've done over the past year reflect this deterioration and the growth trends and outlook. There were no changes in the last quarter. As I mentioned, this resilience has continued to impact, has continued to be demonstrated in the US economy. But definitely it's also because we have done a lot of downgrades in 2022. We have notably downgraded a lot of manufacturing sector, as we are seeing more signs of slowdown in the manufacturing industry. So for example, we downgraded the paper, the wood sector, the metals sector also, as well as construction as a result of the decline in the real estate activity sector. At the same time, we also decided to upgrade the energy sector as higher energy prices are supporting North American economies, and both the US and Canada are our net energy exporters, so higher prices are also probably playing a role in this resilience that we are seeing currently in North America. So the last slide just wraps up the key messages that I've tried to give you today. So if I keep it very short, there is some resilience, yes, in the US economy, and this is good news. This resilience might continue, but at the same time, we have to be aware that risks are rising and that much of the risks have not disappeared. So slower growth is likely coming, and risks for bankruptcy and insolvency activity are on the rise. So I'll leave it here, and I'll leave the floor to Patricia. So thank you for your attention. Looking forward to your question at the end of this session. Thank you again.
Thank you, and welcome, Patricia. Sorry.
Okay, no, thanks a lot, Ruben and Carol. So we're now going to move to the south and to talk about our updated outlook for the Latin American region and how do we see activity moving going forward. So I would like to first start with our updated GDP growth forecast. So we're expecting activity to lose steam along the year, going from an estimated growth of 3.8% last year to 1.7% of growth in 2023. This is mainly driven by cooling down global activity affecting commodity prices. So we have average lower commodity prices compared to the previous year. And of course, Latin America as a major producer and exporter would be impacted not only by lower demand, but also lower prices, and due to the strong tightening of monetary policy implemented by central banks in the region. So this scenario of slowdown is still the baseline scenario for all the 7 largest economies in the region. So for all these economies, we're expecting growth to lose momentum. And 2 remarks. So in 2 markets, we expect a recession. The first one is Chile. So in Chile, we see actually a mild recession, but coming from a very high base of comparison, since the economy was growing very fast, rebounding very fast from the COVID, notably pulled by household consumption, and now there's a kind of normalization. Yeah. In terms, the second market would be Argentina. So in Argentina, the scenario is more quite more sensitive. We're expecting a recession of 3.5%. One issue is the drought facing and affecting the agriculture sector, and also the mounting macroeconomic imbalance. But we are going to talk about this during the presentation. In terms of inflation, since our last webinar, there were some positive improvements. Yeah? So inflation at that time was already showing some easing signals, and this movement continued and actually gained strength in other markets that were kind of delayed. So for all the 7 economies, with exception of Argentina, this inflationary process continued. Also the case of Colombia, which was lagging behind. So considering our year-end inflation forecast for this year and the next year, well, we see inflation ended this year below the level seen last year and continue to improve next year. So, they will only converge the tolerance range of the central banks next year, but certainly with an improvement already occurring this year. As I mentioned, Argentina is the only exception. So the figures for June will be released today. Maybe some deceleration on a monthly basis, but on an annual basis, inflation will continue to pick up. It's already in 114% in 12 months, and we don't not see in this inflationary process inside. So having said this, in terms of monetary policy, now the tightening cycle in Latin America is definitely over for the largest economies. So they are basically on hold for now. Some smaller countries like Costa Rica or Uruguay started to cut interest rate more recently. We're expecting other larger central banks to follow this movement very soon. So probably starting now in July with Chile, then followed by Brazil in August. In the 4th quarter of this year, Mexican central bank or Peruvian central banks could also start to ease monetary policy. But it's important to say that we expect a very gradual movement. Yeah? Real interest rates will remain at a high level. Yeah? So this is still a warning signal for companies. The exception, again, we have a particular case of Argentina, since interest rates in Argentina is still at below inflation, so with a negative real interest rate. So still possibly we could see new hikes in interest rate in the coming months. But for all the others, we're expecting some easing starting this year, Colombia starting next year, yeah, but to be something very gradual. In terms of exchange rate, so year to date, what we have seen is an appreciation, year-to-date appreciation of exchange rate. And this could be explained first by the external scenario, with some weakening of the USD compared to other currency, disfavoring emerging currency. Additionally, the tight credit conditions in Latin America. So as I mentioned, positive real interest rates, so also an incentive for carry trade, so for borrowing at lower rates and bringing to our countries. Looking ahead, well, of course, exchange rates is always maybe the most difficult variable to try to make a forecast. This depends on many variables, but baseline scenario is that, well, we should end the year with a more appreciated exchange rate compared with the end of last year. But I don't see a further space for a more appreciation in the second half of this year. You know? And the main reason behind this assumption is the fact that, as I mentioned before, we're expecting interest rates to start to easing, to be cut in the coming months, while in advanced markets there's still possibility of additional hikes. Yeah? And so this is our baseline scenario. And for Argentina, well, we have the opposite situation. We have a depreciation accumulated year to date of 44%, but it's still below the inflation accumulated in the period. It's difficult to try to make a forecast for exchange rate depreciation in Argentina right now, but markets estimate that could reach almost 130% depreciation for this year. So now, getting more in details per country. So in Argentina, as I mentioned, we are expecting a recession for this year. We saw a strong improvement in activity when back from the COVID from 2020, after the initial shock in then a recovery in 2021, 2022. But now activity being impacted. Actually, in the first quarter was still more resilient than initially expected. But for instance, the preliminary figure of the second quarter, April, for instance, GDP proxy contracted. Yeah, and we believe that this should be the trend, notably driven by the drought and the agriculture activity. So now activity now is below the 2018 level. Yeah, and it's important to have in mind as well the behavior of exports in recent months. So imports was already contracting as expected, not only due to lower domestic activity, but also due to import controls. But exports they have dropped in the faster pace than imports. And one reason, as I mentioned, because of the drought and the agriculture sector as a main exporter, but also when we take into account agriculture exports and even other exports. And of course, this is not only a warning sign because of domestic activity, but also due to the fact that this is the main source. The agriculture sector is a key source for foreign currency for the central bank, yeah, since it's already faced a shortage of foreign currency reserves. And so this is certainly a point to be followed when we take into account, for instance, this first chart and the capacity of the government to accumulate foreign currency reserves. This scenario has strongly deteriorated since last year. So last year they already tried to create incentives for farmers to sell their inventories. This helped in September, then, but it's like something one-off impact, temporary positive impact. Then again in December, but this year, due to the strong drought, it has not worked. Yeah, and so we have net reserves already, negative net reserves. There are all negotiations with IMF, since one of the main targets established by the IMF was to increase foreign currency reserves. And so it is one of the uncertainty this moment, how would be this negotiation with IMF. And finally, in terms of exchange rate, we see that the gap between the official exchange rate and the parallel one remains very, very high, very big gap. And this will be an important point since we are approaching presidential elections. And of course, this could put further pressure for the government, yeah, in the moments there a lack of foreign currency. Yeah? So the risk of a stronger depreciation remains there. In terms of Brazil, activity surprised to the upside during the first quarter of this year with 1.9% quarter-on-quarter growth. This also led us to review our GDP growth forecast for this year to a 2.2% growth. but it's important to check the details, to break down the from the demand side and also supply side, because we see a weaker composition. So in terms of the demand side, most of this increase can be explained by increase in the net export, and the increase in net exports notably driven by a drop in imports, also indicating the weakening of domestic demand. In the meantime, the domestic demand remained weak. We had, for instance, a drop in gross fixed investments in the period. Also, when we take into account the supply side, what we see is that this growth was strongly driven by agriculture sector. So with the expected record crop for this year, agriculture increased almost 22% on a quarter-on-quarter comparison. So looking ahead, this is not expected to be observed again, of course. Yeah, we believe that the agriculture contribution should still be positive during the second quarter of this year, but not at certainly not at the same pace. Additionally, the still tight credit conditions is also expected to continue to affect activity. So it's important to have in mind something that, well, I started talking about the tight credit conditions and how this is something that could, of course, affect companies, with a very positive real interest rate. But this is notably true in the case of Brazil. So in the case of Brazil, we have the highest real interest rates. Yeah, in spite of the fact that the policy rate Selic has remained on hold since August last year, the banking system average interest rates continue to increase along the following months. Yeah, and so of course now in early this year it became more clear the negative impact in terms of payment experience. So with indicators clearly deteriorating early in the first half of this year, and one of the examples is here the number of Chapter 11 number of companies that filed for Chapter 11 protection, which grew by 52% during the first half of this year. So after remaining well controlled during the last years. Now the peak was observed back in 2016, the second year of the deep crisis that Brazil faces in 2015, 2016. But was controlled afterwards, but this year with a positive trend, and so increasing in a point of attention. In Chile, the figures from the first quarter also showed an improvement, so leaving a technical recession, but the composition was weak too when taking into account the demand side. This was driven by the net export, the increasing net exports due to a strong drop in import, as we see domestic demand reducing. So domestic demand reduced for the fifth quarter in a row, and as you can see here, notably driven by this drop in household consumption, the normalization of household consumption. Looking ahead, we believe that a new contraction in the second quarter of this year probably occurred. We see the business confidence index that remains on a negative threshold during the second quarter of this year, and most of the cases, with the exception of mining activity, that's normally very volatile. Well, but there are some reasons behind that. One is certainly tight credit conditions that we have in other markets as well. Additionally to that, we have some reforms like with difficulties to pass, right? Like tax reform, for instance. Additionally to that, some recent mining foldings like the royalty bill that was finally approved, increasing the tax burden, yeah, or the changes in the lithium rules, and finally the constitutional rewriting process with the plebiscite expected to take place in December. Well, the changes implemented by the Congress since the failed attempt now when the first draft was rejected in the plebiscite in September, will probably lead to a more moderate changes to Chile pro-business model. But anyway, still is an uncertainty in the short term since the plebiscite will only take place in December. When we talk about Colombia activity, well, it's also expected to decelerate this year because of a high base of comparison. So Colombia, similar to Chile, was also recovering fast from the COVID. Well, the first quarter was still more resilient than expected, with 1.4% quarter-on-quarter growth, but again explained by net export, while domestic demand drops 0.6%. And notably driven, I would highlight here is the gross fixed investment. So gross fixed investment dropped more than 9% in the quarter. And as you can see, it's now below the pre-pandemic level, so the level of Q4 2019. And behind that is not only the tight credit condition, but I would also say the political uncertainty. So the government of the left president Gustavo Petro facing lower popularity, also reducing its strength in the Congress, with also many key reforms that he has tried to pass and facing difficulties. So this has increased the political uncertainty in the short term, and also with side effects to activity. Some preliminary figures for the second quarter of this year. So we have consumer confidence. Consumer confidence at the margin improved during the last two readings, so in May and June, but anyway, it remains in a very pessimistic threshold. So I would not expect a strong improvement in activity in the short term. In terms of Ecuador, activity surprised to the downside during the first quarter of this year, with a contraction of more than 3% quarter-on-quarter. 3.4% actually was a broad-based. In the case of Ecuador, was a broad-based contraction when taking into account the demand side. Only the inventory that increased in the period. When you take into account as well the supply sides, like 13 out of 18 sectors contracted. One important point was also natural disasters, also affecting key oil sector. Yeah. Looking ahead, I would expect, of course, some improvements, or not a new contraction in the second quarter, for instance, but still a weak growth perspective for this year. Also because of, not only because of relatively lower oil prices, and that affect as a important sector, but also due to the political uncertainty that gained momentum in May, when President Guilherme Lasso used the constitutional possibility of calling for the cross-death, which now calls for early election that will take place in August. So now the country will hold presidential elections, as well as will renew all its national assembly. So this bringing some cautions in the short term, and of course this also limiting the capacity for investments to grow ahead. Similarly, we can see as well here the country risk assessment, also with an increase year to date of the risk associated with the country. I would say this due to oil prices, but also political uncertainty in the short term. Moving to Mexico, we have a different story here. So Mexico has, at the same time, it's also surprising to the upside, but I would say that this time not because of net export. This is actually due to domestic scenario. So notably household consumption that remains very resilient. This can be explained by a few reasons. So the employment market, job market, that's still supportive. Still strong remittance as well coming from the US, despite the fact that we have an important exchange rate appreciation year to date. So limiting the gains when converting to the Mexican peso, but anyway, it's still at a strong level. Yeah, and the additional factor is the gross fixed investment. So gross fixed investment also contributed positively during the last quarters, and this may be also a sign of that Mexico is benefiting from the nearshoring trend. As we see the country very well positioned to benefit from this trend due to its proximity to the US, the trade agreement, the broad-based manufacturing industry. Looking to the figures, preliminary figures for the second quarter of this year, for instance, for April, We have the figures for gross fixed investment and household consumption, and they were still quite resilient. Well, gross fixed investment, so when we compare with a long period of time, is still below the 2017 period, but we can see this positive trend more recently, and notably driven by machinery and equipment, while construction is still lagging behind, notably the part of home builders. But we believe that in the near future, activity tends to slow down in line with the US, since we are still expecting the US to slow down, but it has been more gradual than we initially expected. And last but not least, we have Peru. So Peru activity early this year was also affected by the protest, which gained momentum since the end of mid-December after the ousting of President Pedro Castillo, the then President Pedro Castillo, as he was trying to give a coup. And since then, there were a lot of protests, which reduced momentum back in February or March, but activity also affected by the Yaku cyclone. Looking ahead, we are not expecting a strong rebound in activity due to the worries regarding the river of the El Nino, which normally would expect to bring higher rain and warmer weather to the coastal side of Peru, and could impact its agriculture activity, could also affect infrastructure, and the inflation scenario as well, and the political side. So it was announced yesterday as well, a state of emergency for 30 days in the south region. That's a key corridor for the mining activity due to the possibility of political protests regaining momentum next week. So this is also something to be monitored. Well, so these were the main points from my side. Thank you for now for the attention, and we probably now open the Q&A session. Thank you.
Yes, thank you, Patricia. I have already received some questions, so I will start with you. Compared to the scenario estimated at the beginning of this year, is the growth forecast for Latin America for the full year of 2023 better or worse?
Well, we actually reviewed to the upside, slightly to the upside, our GDP growth forecast for this year due to the generally better than expected activity in Q1. But as I mentioned for most of the countries, the contribution was not exactly what we wanted. Now, so was actually driven by a stronger contribution of net exports due to a reduction in imports, while domestic demand was weakening. So I expect this to prevail. I expect the domestic demand to continue weakening in the coming quarters. But looking at the general picture, yes, activity expected for this year, it will be slightly better than we believe early this year.
Okay, thank you. Ruben, what are the global trends for the automotive sector?
Thank you for the question. So for the automotive sectors, I think we have to note some improvements, notably when it comes to supply chains. As you're all aware, the automotive sector was gripped with supply chain issues, bottlenecks. We talked a lot about semiconductor shortage, for example. Some of these has eased, and as is eased quite meaningfully as China has reopened, as production capacity has picked up, and as also demand for vehicles has cooled a little bit from the highs. But while there is some improvement, it is important to note that conditions remain challenging. So first of all, the supply chain disruptions, notably semiconductor shortage, is not quite over and continue to constrain sales. We are seeing some sales volume in the main markets trend up, but they remain below their peak levels before the pandemic. And also we have to look ahead, and we do see some pressures on margins as prices of vehicles have stabilized and are likely to decline somewhat going forward. There are also some concerns on consumers globally. We are seeing a cautious recovery for the Chinese consumer, of course, a big car market, and with pressures from higher inflation and high borrowing costs. There is also some pressures for the consumer in the main markets in Europe and North America. So overall, yes, our assessment for the automotive sector is still one of challenging and higher risk than average going forward, and this is the case in all regions.
Okay, thank you, Ruben. Patricia, what are the main political events to be followed in Latin America in the second half of this year?
Well, I think that the next important event, something that was not in sight early this year, that, as I mentioned during the presentation, that is the general election to take place in Ecuador in August 20. Yeah, when now the president and the National Assembly will be renewed, will be elected. Then we have presidential elections in Argentina in October 22. The race seems very, very tight. So from the ruling side, we have the Sergio Massa, the economy minister, leading. Yeah, it's not clear the center-right main opposition, Juntos por el Cambio, Patricia Bullrich or Horacio Larreta are the most competitive candidates. And finally, the outsider Javier Milei. So this is expected to be a very tight race and probably going to a runoff. And well, still Chile with the constitution rewriting process. That's something, the plebiscito that I mentioned that will take place in December is also an important event to monitor the political side.
Okay, thank you. And last question, sorry guys, but we are already out of the time. Before I go to the last question, I remind you that you will receive the presentation today in the afternoon, okay? Patricia, what is the economic growth forecast for Panama, taking into account the presidential elections?
For this year, our GDP growth forecast is still of a solid growth of 5%. Last year, the economy grew strongly, like 10%. It's now half, but still strong. I would say that the worrying signs for election, I believe that the impact for this year is still limited because elections will be in May next year. So I think it's early to say about, President Cortés cannot try to run for a re-election, but I would have more detailed information. Probably we have a better outlook next year. But for this year, I think that Panama would still benefit from possible well-positioned position to benefit from nearshoring also as a hub for trade as well. But I would expect activity to lose some steam, not only because of high basic comparison, but also assuming a lower global activity. Yeah, so despite the fact that they can still attract high investment, looking at the mid and long term, in the short term, trade activity in the canal would reduce because of a lower trade momentum, globally speaking.
Okay, thank you very much. Thank you, Patricia, Ruben, Mariano. Thank you, everyone, for coming. The questions that we didn't answer during the sessions will be answered individually by email. If you have any other questions that you didn't write to us, please feel free to contact us and we will be glad to help. Thank you, everyone. Have a nice day.
Thank you. Bye-bye.
Thank you.